Well, welcome everybody. Thank you for joining us this evening. Uh, Tonight, this presentation on legacy planning is given by Glenemede, and we have Adam Konish, who's the Director of Endowed and Foundation Management. He's a Managing Director, and Andrew Slade, who's a Relationship Manager with Endowment and Foundation Advisory, and he's a vice president. And what we're going to be discussing tonight is how you can plan so that your wealth reflects not just your financial success, but your principles, character, and the positive influence you wish to have on the future. So, Adam and Andrew, it's all yours.
Thanks, Carolyn, and
Mhm.
thank you all for joining us tonight. It's a pleasure to be with you. Uh, as Carolyn said, my name is Andrew Slade. I lead Glenemede's Endowment and Foundation advisory team, and we work with a combination of nonprofit organizations ranging from schools and museums to religious institutions and health centers, as well as the foundations that fund them. We also work with philanthropic families whose personal assets Glenmeade manages to help them articulate and execute on their charitable goals. And the role of myself and my team is really to complement the investment management function, which is Adam's area of expertise, and you'll hear from him about that in a moment. Uh, but to augment that with advice and administrative services around planned giving, grants management, tax compliance, donor stewardship, and other topics of interest to charitably inclined clients. Um, and just a note for compliance purposes, while we'll be discussing taxes and investments, we're doing so for general educational purposes, not providing any specific advice. If you need that on an individual basis, we would encourage you to consult your tax advisor before making any financial decisions.
Mhm.
But with that, I'll turn it over to Adam.
Great. Thanks, Andrew. And good evening, everyone. It's nice to see you all. I know some familiar faces here, so that's great. And at the same time, as Andrew said, and Carolyn said, I'm the director of our endowment and foundation group, really overseeing the advisory team as well as the investment team. We're also the investment manager for the Diocesan Investment Trust. We're fortunate to manage the DIT's assets. And one thing I would say is that we take the investment management of all client assets very, very seriously because what we are looking to do is invest in a way that allows our clients to really further their mission. And furthering their mission can be on the investment side, or as Andrew said, on the advisory plan giving side. So we're going to talk about both. So what we were going to do is start off the presentation with a brief economic and market outlook, just giving you an idea of what Glenmeade's outlook is at this point in time as we go through 2026, and then turn it over to Andrew, and he's going to talk about different strategies, as he said, to really be able to make that planned gift. I'd also say we encourage you to ask questions along the way. This is not a forum where we'll sit there and drone on for the next 30, 40 minutes and then wait for questions. If there's a question as we go through on either of what we're talking about, please interrupt, raise your hand, ask the question, because that's how people get the most out of these types of presentations. But thank you very much for having us on this evening, and we'll start the presentation. Wanted to start off by really giving some background on Glenmeade. We talked about who we are, but we wanted to highlight who Glenmeade is. Glenmeade was founded in 1956, and we were founded to be the investment manager of the Pew Charitable Trust, a role that we hold today. So since our founding, we've been managing the Pew Charitable Trust, and we're only the investment manager of Pew. It's a separate organization that actually does all the grant making and the research. At one point in time, we were combined, but we split off in the early 2000s. And really, we have a fantastic working relationship with Pew. We have cross board directors, and so there's a great working relationship with a very, very well-known, respected entity. At the same time, when we look at Glenmeade as a standalone, we have over 50 billion in assets under management. Wow. We manage money for individuals, we manage money for institutions, and we manage money for nonprofits. Glenmeade's unique in the financial industry because we're independently owned. We don't have to worry about quarterly earnings or anything like that. We're basically there for our clients. And so that's something that's really important. And we have a commitment to staying independently owned and private. And then lastly, when you look at the average tenure of a Glenemede employee, it's above the industry average. 15 years industry average tenure, 11 years at Glenemede. People come to Glenemede to stay. So just wanted to give you some quick background that we're very much dedicated to our clients. We only do investment management, no insurance, no public banking, just pure investment management and advice. So with that, what I wanted to do was go to page 4 and frame out where we were in 2025, and then really more importantly, talk about where we're going in 2026. And we wanted to highlight the asset class returns in 2025 because 2025 was a year where we saw a lot of market volatility. So if you look at the top of the page, what you'll see is that international emerging markets, as well as international developed markets, had extremely outsized return. Both of those were up more than 30%. And just to put it out there, that's not normal. It's not even close to normal from the return of an equity market index over a 12-month time period. Following suit, the US markets were up double digits, but in the teens, as you can see, 17.8 for large cap, think S&P 500, and then the smaller stocks, 12.8%. And then as you go down, you can see strong returns all the way down to fixed income. And when we take a look at this, we were really happy that we were able to, participate in this market rally. But at the same time, when we say what do we look for in 2026, we're not looking for double-digit returns in the 30s or even the 20s. We think it's reasonable to assume that going through 2026, high single-digit returns in the equity markets, low single-digit returns in the fixed income markets, but positive returns nonetheless. One of the biggest items that caused what I would say volatility in the marketplace was basically the tariffs that were announced in April. If you recall, when the tariffs were announced, the markets went down significantly in the domestic U.S. And the real question was, what was that going to lead to? Was that going to lead to a headwind for economic growth? Was it going to lead to increased inflation? And really, what was that going to do for the prospects of the market and the economy? So as we fast forward to where we are today, what we're showing on this page is called the CPI. It's called the Consumer Price Index. And this is the measure of inflation. All inflation is the measure of our prices going up, which is inflation, our prices going down, which is deflation. And at this point in time, the big fear was our price is going to go up way too fast and make everything unaffordable. Well, that's not the case. As you can see, the markets latched on to the fact that the tariffs were going to be manageable for both the markets and the economy, both here and overseas. The markets stabilized, and as we saw, had outsized returns as we finished 2025. The big question is, where are we going from here? And so if you look at the right-hand side of the page, what you'll see is a dashed blue line. That's where we think inflation goes. And what that means is if you look from right to left, we think that inflation is going to be right around, call it 2.5%. And that being said, that's very in line with historic norms. Now, we might be wrong, right? But at the same time, we created a range of outcomes. And those range of outcomes are shown in that gray shade. And even if we're wrong to the upside, we do estimate that inflation will be manageable at the same time as we go through 2026, even into 2027, based upon what we know right now with the tariffs. So manageable, very manageable from the market and economic perspective. So from an economic perspective, we talked in terms of inflation, we talked in terms of what our expectations are for market appreciation. Well, let's talk about the economy itself. So when we talk in terms of the health of the economy, we use something called GDP, gross domestic product. It really is just measuring, is the economy growing or is the economy shrinking? And so what we do is we start with the baseline. So you can see the first blue bar graph is at 2%. So our baseline assumption is that the economy will grow in 2026 at about 2%. So then you have to take into consider other attributes that could affect that growth trajectory. Now, if you look at the big green bar graph, that's the one that's actually going to add the largest tailwind to growth, and that's called fiscal stimulus. What does that really mean? If you remember back in July, we had the One Big Beautiful Bill Act enacted. That's exactly what that means. So the stimulus package or the One Big Beautiful Bill Act will add about a 1% trajectory of growth to GDP. When you take other things into consideration, what you'll see is that at the end of the day, we're looking for GDP growth on the right-hand side of the page of about 2.7%. Now, we need to put that in frame of reference, put that in perspective. Historically, growth's been right around 3%. So right now, we're right around that historic growth rate for the US economy, which is not a bad thing given where we are. So going forward, when you talk in terms of economic growth, it's positive and in line with historic averages. And at the same time, when we talk in terms of market growth, it's in line with historic averages as well. And then lastly, one of the items that is on the market's mind and many investors' mind is the Federal Reserve. You hear a lot of talk in the media about what is the Federal Reserve going to do with interest rates. And the Federal Reserve controls what's called the Fed funds rate. Think of the Fed funds rate as your money market rate or your savings rate in your savings account. So it's very, very short-term interest rates. And so what the Fed does, they do two things. They look at the level of inflation, and they also look at the level of unemployment. And what they want is basically a stable inflation rate, right around that 2.5 to 3% that we just saw. And they want a stable unemployment rate right around 4.5 to 5%. We have that right now. So when you talk in terms of what is the Fed going to do as we go through 2026, our thought is that they may reduce interest rates by 50 basis points. And the way they would do that is in two 25 basis point decreases. A 25 basis point decrease is 1/4%. So putting it in different terms, 1/4% probably in the next few months, and then 1/4% reduction in the latter part of the year. Why is this important? Well, the interest rate that you pay on your mortgage, credit card, loans, things like that, it's all set to the Fed funds rate in one way or another. So if you have interest rates going down, that benefits everybody. It benefits municipalities, corporations, and consumers. Lower interest means you have lower interest expense. You're not spending as much money on interest. And that typically means that you have more money to save, pay down existing debts, or actually spend in the economy, all of which are positives for growth going forward. So as you have the Federal Reserve reducing interest rates, that's actually a good thing for the economy. But once again, it's very dependent upon what the inflation rate looks like as well as the unemployment rate. And then lastly, I don't think we could have a conversation without talking about AI. And so AI is very interesting from the standpoint of it's very reminds us of what happened back in the 90s with the telecoms, building out fiber, coaxial cable, and so on. And really what we're highlighting here is that when you talk in terms on the right-hand side of the page, the AI build out, you see Google building data centers as well as power centers and Meta doing the same. It's like the question is they're spending all this money, but what does that lead to? The concern is right now is not that AI is going away. AI is here to stay and here to grow. But when you look at the right-hand side of the page, right now, the AI build out, 60% of that build out is on short-term, what I would say, items that have very short-term lifespans. And so they're spending a lot of money on something that's going to be obsolete in a short amount of time. And so that's something that's concerning because a lot of money is going into AI. So it remains to be seen how that shakes out. But at the end of the day, AI is here to stay, but this is something worth watching because that could really affect the way the market moves, especially with regard to those large, magnificent seven stocks, Amazon, Microsoft, Google, and so on, the ones that have been the leaders of the market. We're keeping a very close eye on that. So just wanted to highlight that. You don't hear a lot about that specifically. And then lastly, I have two slides that I'm going to finish up with. Even though the markets have had a heck of a run up over the last, call it what I would say 3 years, there's opportunity there. Why is there opportunity in the markets? So when you look at this graphic, what you want to focus in on is the blue dot. The blue dot is the current level of valuation of that particular asset class. And I'll explain what that means. You want to focus it in on a relative basis to the green line. The green line is the fair value historically of that asset class. So the higher that blue dot is above the green line, the more expensive the asset class is. If it was below it, it'd be inexpensive. And so it's not a surprise when you look at the second column from the left, US large cap growth, that blue dot's high. They've had a really good run. However, when you look at different other asset classes, you can see that blue dot is lower, especially in small cap or even international developed. This is exactly why we always advocate a diversified portfolio because at points in time, it's not really possible, in fact, impossible to market time. So if you have a portfolio that is diversified with these different asset classes, you're going to catch a wave of one doing really well and maybe one not doing so well, but it also allows for you to rebalance your portfolio. So just because we've had big run-ups in the marketplace at this point in time, it doesn't mean that there's not opportunity. And when we talk in terms of a diversified portfolio, it really looks like a portfolio that has core bonds, large cap stocks, maybe some alternative investments such as private investments or real estate. And really, what that does is it lowers your risk. And the way I would highlight that is a diversified portfolio can get you almost the same, if not better, return with less risk than just investing in the stock market itself. And I'll finish up by showing that. So if you look at the right-hand side of the page, what this is showing you is that over the next 10 years, we would expect large cap stocks to return 6.6% and have a standard deviation or volatility profile of 16.5. The way you want to think about standard deviation, that 16.5, is that the higher that number, the more risk you're taking. You don't want to take risk. When you look at a diversified portfolio, it actually has a higher expected return than the stock market itself and a lower risk profile. So that's what diversification gets you. And that's what I was highlighting. There's opportunity out there. You don't want to put all your eggs in one basket. And at the end of the day, diversification over the long term is your friend and actually limits your risk and actually increases your return. I'm going to pause right there before turning it over to Andrew and just see if there's any questions about what we covered or what we haven't covered. Well, great. If anything comes up, feel free to ask as we go through the latter part of the presentation, but I'll turn it over to Andrew.
Thanks, Adam. Um, that's really helpful because I think it's important to recognize that one of the best predictors of whether charitable giving is going to go up or down in a given year is where the stock market has been. So thank you for setting the table there. We're in an environment in which folks who are fortunate enough to own investments have enjoyed significant gains in recent years, but also in an environment in which needs are arguably greater than ever. We've seen many organizations experience significant cuts in federal funding, and where community needs are heightened, where people aren't getting the same level of support for food security or housing, other social services. I know ECS is working to address a lot of those needs in New Jersey. So most of my slides are going to address different ways to give, the how, the strategies to maximize tax efficiency of your giving. And taxes are important, but we need to recognize that nobody is giving to charity purely for tax purposes. No matter how well thought out your planning is, you're never going to end up with more money having given to charity than you would simply by retaining those assets for your personal use. So if you're parting with assets, even if it only costs you 50 cents on the dollar, that's still 50 cents less in your pocket. So why do that? Why engage in the charitable landscape? And there are a lot of reasons. We start with the why in talking to clients and typically find that the reasons fall into three buckets. The first is to advance a philanthropic purpose or a passion, to make an impact on a cause that's important to you. And that's really fundamental to what philanthropy is. Within this bucket, there are lots of more specific reasons and motivations for giving, for wanting to see that impact. For some, it's giving back to an organization that served them or their family, paying it forward. For others, they're giving because their faith calls them to do so. Some people are looking to maximize impact from a sort of utilitarian standpoint, doing the greatest good for the greatest number. There's a movement some of you might have heard about or read in the news that's emerged in philanthropy over the past decade or so called effective altruism, where a lot of tech entrepreneurs have looked at ways to maximize the number of lives saved through charitable giving, and it's an interesting philosophy, and some people take issue with certain elements of it. But it's one approach, and one of the themes of this conversation is going to be that philanthropy is deeply personal. So what motivates you to give might be very different, and how you vet organizations and think about your approach to giving might vary considerably, even among people on this call. Um, so the next big bucket that we see is creating a charitable legacy, to make a gift that's going to outlast you. And maybe that means your name is on a building. Maybe it means that you just find comfort in knowing that your gift will allow for sustained impact after you're gone. Then we have clients who are interested in building and transmitting values across generations. Most are interested in engaging children or grandchildren in philanthropy to some degree, and this can be really powerful. It's a way to take stock of the good fortune that your family enjoys, to instill a sense of duty to give back, to teach family about what's important to you and why, and to practice financial stewardship and teach financial literacy. Finally, utilizing financial and tax advantages. And this has an asterisk because, as I said, it's less about why you're engaging in philanthropy generally, but it might explain why you're giving now, and certainly how you engage. We'll get into some of those specific hows shortly. I would encourage all of you to think about your own why. Why do you support ECS? What brought you here tonight? That's the start of intentional philanthropy, and we find that it makes giving more gratifying and impactful. On the right of this slide, you'll see a wheel, and this outlines the approach that we use in guiding our philanthropic clients. So explore your values, passions, and objectives, develop a philanthropic plan, implement and manage philanthropic structures if necessary, provide ongoing resources and education, engage family members, and then review, evaluate, and refine. You'll notice that there's no finish line here. This is really an endless cycle of exploration, practice, and refinement. And that's one of the unique aspects of philanthropy in the US. Accountability is almost entirely self-imposed. So you as donors get to define your own goals and decide what constitutes success, when to double down, when to pivot. On the next slide, on the subject of defining goals, we think about this with a series of questions. First, what's important to you? What are the core values, beliefs, and precepts about what matters most in life? Maybe it's well-being, creativity, equity, empowerment. This is deeply personal, but it's foundational to conversations about giving. Next, what are you passionate about? Where have you given your time, talent, and treasure? You might have heard of the 3 T's. Some people have introduced a 4th T in ties, those social connections that can be impactful. But I want to acknowledge that while this presentation focuses on treasure, the financial contributions, impact can be just as meaningful from volunteering, sharing your expertise in furtherance of a cause that's important to you. So why have you chosen to give to ECS? Are there particular issues that compel you to act? Finally, what are your goals? What do you hope to achieve through your giving? What legacy do you want to leave? Answering these questions should provide some clarity of purpose and help to determine the direction of your giving, which allows you to be more strategic in thinking about your priorities. Because the reality is that no matter how much money one has, there are limits to their philanthropic resources available, but unfortunately, virtually no limit to the need for those resources on a global scale. So it's important to be thoughtful in picking our spots. Any questions before we move into some of the specific giving strategies? All right, feel free to chime in at any time, raise your hand or unmute yourselves. As Adam said, we want this to be a conversation. I don't want to bore you by talking for the next 20 minutes, but in terms of ways to give, these are some of the most common approaches that we see. The first being cash. This is how most people engage in philanthropy, writing checks, using a credit card to donate through a website. The next step in terms of complexity or sophistication can be donating appreciated stock or other assets in kind. Uh, Third is using retirement assets. And then fourth is a vehicle called a donor advised fund. And I'm going to dive into each of these strategies and assets specifically. So if we turn to the next slide, when we think about gifting appreciated assets, uh, the idea here is to amplify the tax savings from a charitable gift. So if you donate cash, that contribution is tax deductible, meaning that you can reduce your taxable income by the amount of the contribution, subject to certain limitations, if you itemize. Um, you might have experienced over the last decade or so, fewer households are itemizing their charitable contributions or their tax deductions in general because the Tax Cuts and Jobs Act that passed in 2017 significantly increased the standard deduction. That means that most taxpayers now take the standard deduction and don't derive any incremental benefit from itemized deductions or what could be itemized deductions, such as charitable contributions, state and local taxes paid, and mortgage interest. And that has implications for the incentives around charitable giving. Again, it's not going to necessarily stop someone from giving, but it might change the magnitude of how much they give, when they give, or what assets they're giving to organizations, because the after-tax cost of a gift could be higher. Now, there's a caveat to that that I'll touch on later, but a positive development for philanthropy under the One Big Beautiful Bill Act that passed last year that will somewhat mitigate the impact of those changes under prior tax law. So most people are giving cash. They're taking that charitable deduction if they're able to itemize. And that charitable deduction can result in savings of up to 37% at the federal level, depending on your income tax bracket. If you can donate appreciated property, though, you can actually derive greater tax savings by avoiding realization of capital gains. So what you're seeing on this slide is two scenarios. One in which a donor who holds an appreciated asset, think about stock, say you bought Apple some time ago, your cost basis is $10,000. That's what you put into the stock. It's had a really great run up in value. It's now worth $100,000. You have an embedded gain of $90,000. And if you're in a high income tax bracket and you sell that stock, you're going to pay capital gains tax at a rate of 23.8%. And that includes a surtax under Medicare of 3.8%. So that would result in a tax bill of $21,000 and change, leaving net proceeds of $78,000 available to donate from those proceeds. However, if you take the exact same stock and you donate that to a charity such as ECS in kind, meaning you're not selling it, you're transferring the actual shares of stock to the tax-exempt organization, they can sell that tax-free. They reap the full market value, that $100,000, and you receive a tax deduction of $100,000. You never pay that $21,000 in capital gains tax. So looking through your portfolio, your personal balance sheet to identify assets that have appreciated in value over the long term, it's important that the asset be held for at least a year in order to receive this tax treatment. But if you do that and you transfer those assets in kind, it's really a win-win. It frees up more of your wealth for charitable giving, and it doesn't cost the charity anything. So that's an approach that we recommend to all of our private clients who hold appreciated investments. When they're thinking about making a charitable gift, we say, pause before you enter that credit card number or write the personal check. Give us a call and we'll see if there's a better way to do this. Maybe they were considering giving $1,000 to an organization and they decide that they're going to give twice that because it really costs them less at the end of the day. This same strategy can be applied to assets other than marketable securities, stock in public companies. So if you own real estate or if you're a business owner, private stock, LLC interest, commercial property, residential property, all of these assets are potential candidates for in-kind contribution to charity. Sometimes charities aren't equipped to receive those assets directly, but there are giving vehicles that can be used as a clearinghouse for those contributions. And I'll touch on that when we get to the donor advised fund section. Any questions? All right. Qualified charitable distributions. So qualified charitable distributions are a way to utilize assets in an individual retirement account for charitable giving and to avoid taking the distribution as income. If you have a traditional IRA, most distributions will be taxable to you as income. And even if you don't need the income, you're required to begin taking distributions at a certain age. For most people, that's 73 years old currently. So once you turn 73, the IRS says you have to start withdrawing money from your traditional retirement account because it's only upon withdrawal that the IRS will receive the tax revenue from that distribution. They don't want it to stay in there forever. And some people say, I don't necessarily need that income, or I would rather redirect that income to a charitable cause that's important to me. There's a mechanism called a qualified charitable distribution, or some people call it a charitable rollover, through which an IRA holder of 70 and a half years or older may direct up to $111,000 per year indexed to inflation. So that'll go up in future years, to charitable organizations of their choosing. So you could direct a QCD from your IRA to ECS. They receive those funds by check from the IRA custodian, and that distribution is never taxable to you as income. It eliminates the income taxes upon transfer, and if you're subject to a required minimum distribution, it can satisfy your RMD. So we see a lot of clients who, for various reasons, don't want to inflate their taxable income in retirement, and who direct the bulk of their RMDs to charitable organizations. And this is a way to preserve the tax benefit of charitable giving, even if you don't itemize. So you don't need to itemize a deduction because you're not taking the distribution as income in the first place. David?
Yeah, would you consider a qualified charitable deduction as a planned gift?
Not necessarily.
Mhm.
No, and a lot of these strategies are gifts that could be made during one's lifetime, but I'm going to touch on sort of the spectrum of what assets and types of accounts are best suited for lifetime versus planned giving.
Mhm.
But no, I would not characterize a QCD as a planned gift.
Right.
There are other ways to use retirement assets for planned gifts through beneficiary designations. So traditional retirement assets are not the best assets to leave to individual heirs
Mhm.
because any distribution from such an account is taxable as ordinary income.
Mhm.
So even if you don't have a taxable estate, if you leave your traditional IRA to your children, for instance, they're going to be required to
Okay.
take distributions from that account, and they will pay tax on every dollar that's distributed from it.
Mhm.
If you have non-qualified assets outside of a traditional retirement plan that you can leave to your heirs instead and name a charitable organization as the beneficiary of your IRA, the charity is not going to pay that income tax on the retirement assets that they receive upon your death. Deborah?
Can you explain what Father Dave meant when he said planned gift? What is a
Yeah,
planned gift?
great question. So there's not a strict definition of what constitutes a planned gift, but generally it's one that is not made outright during your lifetime. So there are various types of planned gifts, but one of the most simple examples is a bequest under your will, where you indicate your intention to leave assets to a charitable organization upon your death. Beneficiary designations are another form of planned giving. And then there are planned giving vehicles that are a bit more complex, that often require infrastructure within the nonprofit you're supporting, but that can provide income during life and a residual benefit to the nonprofit at death. So you might have heard of a charitable gift annuity or charitable remainder trust, pooled income fund. Those are some examples of planned giving vehicles. Any other questions?
Yeah, Andrew, I've heard that like 80% of planned gifts are simple bequests. Is that your experience as well at Glenemede?
Um, so I think that that statistic is probably true in the aggregate. Um, at Glenemede, we have clients who take advantage of bequests, and we have many who have more complex needs and charitable goals, and who might decide to set up a charitable remainder trust or a charitable lead trust or a private foundation or other structures that bear a greater cost and administrative burden, but that can provide for more tailored financial planning capabilities if the level of wealth and complexity of the financial plan warrants that. But for the vast majority of folks, a simple bequest is going to be, or a beneficiary designation would be the best way to effect a planned gift.
So for an organization like ECS, where we haven't done anything really with planned giving, that would be a good place to start, wouldn't you say?
Absolutely. Yeah. Bequests, beneficiary designations, and those can apply not just to retirement assets, but to life insurance policies as well. There's no legal work required. You don't need to create a new vehicle or file separate tax returns. So yeah, bequests and beneficiary designations are the low-hanging fruit of planned giving. And it's in preparing for this conversation, we spoke with Carolyn about some of the challenges and pitfalls of more complex planned giving programs for small and medium-sized organizations, where there can be risk if they're not able to administer those vehicles effectively, or if there's concentration in a gift annuity, for instance, among a single donor or a small pool. So we always advise clients to be thoughtful and take it one step at a time as you're beginning your planned giving program and outreach to donors, to make sure that you're not taking on more than the organization can handle, because a lot of these are long-term commitments. You might have somebody who enters into an agreement with the organization at 60 and they live to 90 or 100, and the people who put that agreement in front of them have long since retired. But their successors are left to deal with the ongoing responsibility for administering the giving vehicle.
Mhm.
Any other questions?
Would you clarify one thing for me? If you have a married couple, one of whom has a retirement account, when does that retirement account transfer to the other spouse upon the death of the first spouse? And not have the tax consequences, so it would only be on the, I mean, at what point would you think it would be advisable
Yeah.
to talk to them
Oh,
about?
good question. I think it depends on the financial circumstances of the donor, and their estate plan. So for some folks, the retirement assets will be a necessary element of the financial safety net for the surviving spouse, and the first to die might not be comfortable saying I'm going to part with these assets um, upon my death, because they want to ensure the financial security of their partner. And for others, they might have other assets that can be left in a more tax efficient way to that spouse. So if you have appreciated stock, um, you're going to receive a step up in basis at death that's going to allow the spouse or inheritor to sell without realizing capital gains. Um, Maybe there are life insurance policies in place that will provide for them. It just depends on what other resources are available. There's not really a one size fits all approach. But I think that educating donors about the different options available to them um, can get them thinking and talking to their financial advisors and estate planners about what makes the most sense. Um, there's a lot of industry research that shows that donors want to have these kinds of conversations with their advisors, and most advisors are not initiating them. I think some are uncomfortable talking about death, and some are uncomfortable talking about charitable interests and goals that go beyond the core technical planning aspects of the advisor's mandate. But particularly among high net worth clients and donors, there's an appetite for that kind of conversation. And if their advisors aren't initiating it, um, perhaps the nonprofits that they're passionate about can do so in a way that will drive that conversation and planning forward.
And this is Deb again. I'll put my video back on. And, if we're talking more about a smaller community, a smaller church, that probably doesn't have a lot of high net worth individuals,
Mhm.
you know, we're going to need to have I mean, basically what you just said is if people start asking questions about the tax consequences of transferring a retirement account upon the death of the spouse that owns it, there's a myriad of answers. And as a church, we can't answer that question. We have to refer them
Right.
back to their financial advisors if they're in a situation like that. Um, but, for some of us, we need to have this conversation about people who aren't high net worth individuals.
Mhm.
Many of those people we have learned in our church communities are the ones that give the largest portion of their
Yep.
assets to things like their beloved church. So
Yeah.
Mhm.
just keep it. Yeah, that's all.
Oh, no, absolutely. There was a report recently about um, the relatively low proportion of income and wealth that's given by the wealthiest Americans. There are some notable exceptions, but for the most part, the percentage of one's assets that are given by a lot of billionaires is minuscule, while
Okay.
there are a lot of people who are um, living paycheck to paycheck or on a fixed income in retirement, and who are faithfully giving 10% or more each year to their church or other organizations that are meaningful to them, and that's a real sense of obligation. And I certainly I have tremendous respect for that. There Some of these strategies are going to be relevant to them, and some of them only make sense if you own certain assets or have a degree of financial security that allows you to engage in some more creative planning. But one of the changes to which I alluded under the recent tax law, the One Big Beautiful Bill Act, or OB3 as some call it, uh, is a new above the line deduction, or what some call a universal charitable deduction. And that allows individuals who don't itemize to deduct $1,000 a year for single taxpayers or $2,000 for joint filers. So I talked about the folks who maybe itemized pre-2017, and then once the Tax Cuts and Jobs Act took effect, started taking the standard deduction. For them, there were no tax savings, and they were probably still giving what was a significant amount of money to them, but not receiving any subsidy for it. This new provision, it's not perfect. It's maybe not as robust as a lot of folks in the nonprofit sector would like, but it's a good starting point to expand the preferential tax treatment that has historically benefited or skewed towards the high net worth donors to individuals who might give $50 or $100 at a time, who over the course of a year as a household maybe give a couple of $1,000s, and that's a lot of money to them. And this is going to provide them with some tax savings. So I don't know that most donors are aware of that. It only took effect in 2026, so it won't affect returns filed this spring. But educating donors about that new benefit, and again, thinking about how that reduces the after-tax cost of their giving. So maybe they're going to give more than the $2,000 that they as a married couple can write off under this provision, but that still that could free up additional resources through the tax incentive and subsidy. So directionally, I think that it's a positive development for the nonprofit sector, and there's an ongoing effort on the part of the sector to expand that further, just to democratize the tax benefits for folks who aren't necessarily in a place to utilize a planned giving structure like we've talked about. Deb, that is, it's referred to as an above the line deduction or a universal charitable deduction. And again, the premise is just it's above the line, and that on the tax form 1040, there's a line where you can claim certain deductions before you begin itemizing, and that means that you can take the standard deduction and the $1,000 or $2,000, even if your other itemized deductions don't get you over the hurdle, which is currently about $16,000 a year for single taxpayers or $32,000 for joint. And that's a high bar, and it includes not just charitable deductions, it includes mortgage interest and state and local taxes paid and some extraordinary medical expenses, but still, it's a tough hurdle for the average taxpayer to get over. That's actually a good segue to the slide you're seeing now on donor advised funds. These are a very trendy charitable giving vehicle that has really taken off in popularity over the past 10 or 15 years. So donor makes a contribution to a DAF. That's an irrevocable gift. They receive an income tax deduction up front. Assets within the DAF can be invested. Any appreciation or income is tax-free. The assets are out of the donor's estate. And from the DAF, the donor or their designees can initiate grants to charitable organizations of their choosing. So that could be ECS and any number of other organizations that are of interest to the donor. So the core value proposition here is that you're separating that income tax deduction from the deployment of assets to the intended charitable beneficiaries, which means that you can align the deduction with tax savings when they're most valuable to you. And you can also stack some of these strategies by contributing appreciated assets to the DAF
To the fund.
to avoid realization of capital gains. DAFs are generally well suited to receive even the more complex assets like private business interests in real estate, cryptocurrency, things that some nonprofits are not equipped to receive directly. So maybe somebody has an asset of that nature, something more esoteric. They put it into a donor advised fund, they receive the tax deduction, and then from the DAF, they make a grant to ECS and they make a grant to their church and they make a grant to the local school or hospital or whatever causes are important to them. It provides a lot of flexibility in planning and maximizing the tax savings from charitable giving. It also streamlines reporting and record keeping, since you get one receipt for that one contribution into the DAF. You don't have to worry about tracking down acknowledgments of every grant out of it. Deb, there's no maximum. Minimums depend on the DAF sponsor. So there are some out there that have no minimum at all. Some of them might have a minimum of $1,000, $5,000, $10,000, depending on the DAF sponsor. And DAF sponsors can be community foundations. They can be single issue charities. Some universities have their own DAF programs for alumni. They can also be entities that are set up by financial services firms. So Glenemede has a DAF program that we offer in partnership with a nonprofit called National Philanthropic Trust. They work with a number of other investment and wealth management firms across the country to provide DAF solutions for our private clients. But some of the household name asset managers like Fidelity, Schwab, Vanguard, they have DAF offerings that you can open online through their website. Very low fees, and for most of them, no minimums. So we've seen increased popularity in DAFs among a wide swath of donors. Sometimes those who are at the very, very high end, who maybe would have historically considered a private foundation as their philanthropic structure of choice, who see a DAF as a streamlined, less costly turnkey vehicle that allows them to do essentially the same thing. And sometimes among donors who aren't high net worth, but who want to give and derive some tax benefit from their philanthropy, and can do so by bunching what might be years worth of charitable contributions into a DAF contribution that's large enough for them to itemize under current tax law, and then making grants out of the DAF to their favorite charities, the same ones that they would otherwise support directly, but doing so in the same amounts at the same cadence that they're accustomed to, so as not to disrupt the cash flows of those organizations. There are some other use cases where we see folks using DAFs because they want to give anonymously. Most DAFs allow that. capability. Sometimes that's just a function of humility. Sometimes it's they're giving to causes that they don't necessarily want their name attached to, potentially controversial. And sometimes they just don't want to be solicited in the future. So the DAF can serve as a good vehicle for donors who are concerned about privacy. And it's also a tool for next gen and familial engagement more generally. You can set up a DAF and authorize other individuals to make grants from it. So you could set it up and fund it personally and name your children as authorized advisors so they have access to pursue their own philanthropic interests through that fund. And you can use this as a planned giving vehicle by designating one or more charitable beneficiaries to receive funds from the DAF at death. Most DAFs will also allow you to name individual successors. So if you want this to be a multi-generational endeavor for your kids or grandkids to take over responsibility for distributing these assets when you're gone, you can do that as well. I know we're at the hour mark. I'm happy to keep going, but I understand if anyone needs to drop off, I will try to get through the last couple of slides as quickly as possible. But I appreciate the questions, and if anyone else has any, feel free to chime in. So some assets are really well suited for lifetime giving, while others are better for planned gifts to be completed at death. And this is just a sample. It's not exhaustive by any means, but these are some of the assets that we'll often get questions about in terms of, can I give this during my lifetime? Can I give this at death? What makes more sense? So commercial annuities, very difficult, if not impossible, to transfer during life, and the tax consequences of doing so tend to be quite unfavorable. However, if there's a death benefit associated with the annuity, naming a charity as the beneficiary is a great way to use those assets to support your charitable causes. Life insurance, if you have a cash value life insurance policy, it's possible to give that to charity during life in most cases, but the tax treatment's not going to be particularly attractive. However, naming a charity as the beneficiary on that life insurance policy can provide considerable benefits to them, and depending on whether the policy is paid up, may be more attractive to them than receiving that in kind anyway. Traditional retirement assets, we talked about both qualified charitable distributions during life and the ability to designate charities as the beneficiary of those assets at death. Cash assets are great to give during life if you have the means, as with appreciated securities. And we talked about the potential capital gains tax savings from donating those assets to charity. But cash and appreciated securities are assets that people also like to hold on to during life because they provide a lot of flexibility and assurance that individuals will be able to meet their financial needs. And they provide more flexibility from a tax standpoint, in that if you hold the cash, you're not going to owe anything on the cash from spending that to meet your lifestyle needs. So when to give is really a personal question that's going to depend on your overall financial circumstances, your retirement plan, your estate plan. But there are also some emotional considerations around what makes the most sense based on your goals. So we think about the joy of giving while living, getting to witness the impact of your generosity while you're still alive. Some people really enjoy that. Some people don't want the attention. They might have concerns about their financial security, and they might say, I'm not willing to part with this money now, but if there's money left over when I'm gone, I'm happy to leave that to ECS or another charity that's important to me. I think that there are a lot of nuances to this conversation, and donors would be really well served if they could get their professional advisors and the charities that they care about around the same table to think about the best approach to giving. But sometimes those parties are working at cross purposes, unfortunately. Um, so just we've talked about lifetime gifts, plan gifts, bequests, beneficiary designations, what I'll kind of categorize as ultimate gifts. No matter how they're structured, they can be transformational, sometimes orders of magnitude larger than what one might give on an annual basis. You might have heard news stories of folks who lived modestly, gave $50 a year to causes that are important to them, and then left the organization millions. If you're not leaving millions, that ultimate gift can be hugely impactful by allowing organizations like ECS to invest in the future. This is often how organizations establish and grow endowments to ensure that mission carries on after you're gone. So again, I want to be cognizant of time. Thank you all for your attention.